Since 1954, 8 tax law reforms have been enacted, and 6 of those occurred in the first or 5th year of a president's tenure. 2017 is the first year of a new presidential administration, so here's an overview of the reforms that could be headed our way in 2017. From both sides of the aisle, policymakers agree on 3 major goals: encouraging saving and investment in the U.S., cutting the time and money spent on tax planning and preparation through tax simplification, and transforming IRS into a customer service agency. Although we don't know exactly what the next presidential administration will do, both parties have published policy papers outlining reforms that would affect individuals. A Trump administration would simplify the tax code by reducing the number of brackets from the current total of 7 to 3, a 12%, 25%, and 33% bracket. This aligns with the House Republican plan. The Republican-controlled House Ways and Means Committee has proposed a postcard-sized tax form for families. The committee also proposed eliminating the marriage penalty, the alternative minimum tax, and all taxes on inheritances. However, the exemption parents receive for each child and many other deductions would be eliminated. A Trump administration would reduce the tax rates paid by businesses. Businesses would be allowed to write off capital investments immediately in 1 year instead of depreciating them over many years. Corporate tax rates would be reduced to 15%. The Republicans would also give U.S. businesses a one-time 10% tax cut on income earned in other countries and repatriated back home. A Clinton administration would add a new bracket for top earners. Top earners would be hit by a 4% surcharge on adjusted gross income, AGI, of more than $5 million. And the Buffett rule would impose a minimum effective tax rate of 30% on taxpayers with an AGI of more than $1 million. A Clinton administration would also cap the value of deductions and exclusions at 28%. Another reform proposed by Mrs. Clinton is a new capital gains tax rate schedule that decreases tax rates on long-term capital gains to encourage long-term investing by individuals and which would help retirees. Additionally, Mrs. Clinton proposes reducing the estate tax exemption. Instead of exempting the first $5.45 million from estate tax, the exemption permitted individuals would decrease to $3.5 million. Instead of a couple passing $10 million to heirs tax-free, the exemption would drop to $7 million if Democrats get their way. The Clinton camp has also proposed reforms to crack down on multinational corporations from avoiding U.S. taxation. Mr. Trump says his proposals would create 25 million new jobs and restore U.S. annual growth to 4%. According to the Trump campaign, their plan would reduce government revenue over the next decade by $4.4 trillion, although the Nonpartisan Tax Policy Center estimates this to be closer to $10 trillion. Mr. Trump says the tax cut would bring growth much the same way as the Reagan-era government budget deficit fueled the defeat of the Soviet Union and led to a sustained period of American growth. The Tax Policy Center says Mrs. Clinton's plan would add revenue of $1.1 trillion in the same 10-year period. The Democrats would increase tax for the most wealthy Americans, while the Republicans would cut taxes across the board. Both candidates agree on a number of proposals that would encourage greater investment in the U.S. economy. We'll keep you apprised of proposed tax reforms from both sides for financial planning purposes.